Welcome back, and you're watching Commodity Champions. Let's look at the metal space now. The industrial metals are on course for posting yet another weak month. Weighed down by the weak economic data, all the eyes are now on the G-20 meeting in Argentina, which is slated to the end of November. The US President Trump is expected to meet the state heads of China, Russia and Saudi Arabia. The tariff war front, China has sent 142 concessions to USA in writing. Remember, the US has imposed tariffs on goods worth $250 billion on China. It is also expected that the US will increase tariffs to 25% from 10% from Jan 1st in 2019. We have Paul Bartholomew and Keith Tan from S&P Global Platts now joining us to decode all what that can be expected in that space going forward. Paul, hi. Coming to you first. If we look at the metals, they have been negative in 2018. Do you see any change at all in fundamentals, or do you see this spilling over into 2019?
I mean, the year's been fairly strong, but there's no doubt it is tapering off a bit. Particularly in China, we're seeing a lot of sort of prices coming off, a bit of softness in the economy, particularly in some of the consumer-driven segments and manufacturing. Yeah, so I think we could sort of start off a little bit sort of soft in 2019 as well.
Paul, what's your also sense on the G20 meeting at the end of this month? There is expectation of perhaps some optimism on one side, and then there are some in the market who expect a showdown out of this. What are you expecting?
Oh yeah, I think it's going to be watched very, very closely. For what emerges from the meeting. President Trump and Xi Jinping. Often you find President Trump, when he meets the person in, face to face, he tends to kind of rein in a bit of his rhetoric. So I think if we see some images of China and the US shaking hands and smiling, and sort of promising to have sort of more positive talks going into next year, that will no doubt have a positive impact on sentiment. I mean, the Chinese market is very sentiment driven, particularly steel. So we could have a bit of sort of short term improvement in prices, but then I think it very quickly reverts back to fundamentals. But it will definitely be a bit of a fillip to the sector if there's some positive signs from the G20 meeting.
Oh, absolutely. And who wouldn't want to watch all of those appealing visuals from that meeting there? But Paul, what's your sense on the Chinese demand? Because it already has started having an impact on the Chinese on-ground demand, the whole US-China trade war there.
Well, there's some sectors a bit soft at the moment. I mean, at the moment, Chinese people don't seem to be buying quite as many fridges and cars and air conditioners. I mean, you've seen some of the auto sales numbers, almost back to 1990s levels of low growth. So I think, we are sort of ending the year on a weak note, particularly the sort of manufacturing. But the big one in China is always construction and infrastructure. People are still buying houses, they're still building apartments, but the Chinese government has talked about putting some stimulus back into infrastructure in particular, because that sector's been sort of flagging a bit over this year. And I think also we're going to see China try and support the private sector a little bit more as well, which it hasn't done so much of recently. So I think because of some of the difficult external factors, we should see a bit more support, which could have some positive knock-on effects for some domestic end user segments.
So what you're saying, Paul, is that the whole sector is not looking weak right now, and there are some green shoots that you can see emerging here. What metals really are your favorite if you had to pick any?
I wouldn't be surprised to see a little bit of initial softness in 2019. I think some of the stimulus, some of the investment from Beijing is going to take a bit of time to flow through. China's still, for example, still producing a lot of steel. We're seeing demand for flat steel sort of coming off. As I mentioned, some of those end-user manufacturing segments are soft. So I think, because the danger is, or the concern around the world is, will China lift its exports, to offset slower domestic demand? And we could see a little bit of an uplift in some of the steel exports over the next couple of months. But I mean, this year was going to be down a little bit on last year, maybe about 5 to 7 million tonnes on last year's 75 million tonnes. But I do expect to see a bit of initial softness, and then we go into that Chinese New Year period where demand's always down. So it could be a bit, it could be a bit soft in Q1 next year.
So, before I let you go, I really want to come back to the G20 point yet again. And if there is no positive that comes in from there, are the markets then ready for a higher tariff? Because that would go from 10% to 25% from 1st of Jan.
Yeah, well, that's obviously going to have a big, negative impact on sentiment. And I think that, even if there is a kind of positive meeting at the upcoming G20 meeting, I don't think necessarily the US is going to change its stance on China and how it sees the trade imbalance. So, it's always difficult to predict what President Trump's going to do in terms of, he might decide to push back some of the additional sort of trade tariffs, or he might, just forge ahead. But, I expect that's still going to have some negative impact on market sentiment. So I think, again, China's going to have to sort of turn back to sort of its own domestic sector to a certain extent, or we might see a bit of some sort of price pressure in the region if China does lift some of its exports.
Well, Paul, thank you so much for that analysis. Keith, coming to you now, the G20 meeting is slated at the end of this month. I've asked the same questions really to Paul, but I would want to know your opinion on how important is it for metals as a sector?
Well, I think it's a bit up in the air. During the two recent summits that took place in Southeast Asia, in Singapore and in Papua New Guinea, I think the atmosphere between the US and China appeared to be still a bit tense. So all eyes will be on the upcoming G20 conference, as you've said. But I think most people are seeing that as a bit of for signs of perhaps the U.S. and China starting to sit at the same table and start to kind of talk terms, right? So I don't think people are expecting major announcements, perhaps baby steps towards reconciliation between the two giants.
Keith, what is your sense? Because the last 6 and 7 months have really been consumed by the whole US-China trade concerns. We do see it spilling into 2019. Is there yet another big factor to watch, or would you continue to focus on this one?
Right, so you mean the focus has been really, I think when the first shots of the trade war were fired, steel and aluminum clearly were the first victims, so to speak. Well, we know clearly that for steel, actually China does not export that much to the US. So we next are now looking at what's happening in the downstream segments. And we are seeing actually consumption growth for white goods in China slow. So mind you, it's still growing, but it's at a slower pace. So I think that what the trade war has exerted on the minds of consumers is really like that of more of a sentiment impact rather than direct impact.
Keith, the only metal that has seen strength and is closing in positive for this year has been the steel price, is up by 15%. But the kind of increase that we have seen in production, do you see that one factor putting pressure on the prices here as well?
Well, you're right in saying that steel has posted really, we're enjoying sort of a mini golden age, if I might call it that, this year and as well as since actually the middle of last year. And that's largely as a result of supply-side reforms that China has taken to remove capacity. What we see here, however, as you've rightly pointed out, is despite the removal of capacity, we've seen production actually increase and to a record high for China. I think people are trying to put together, this seemingly conflicting figures. And what I think we need to pay attention to here is clearly a lot of the figures accounted for by producers that were not necessarily reporting their output to the official statistics bureau in China, those mainly produced by induction furnaces. They've now since been eliminated, and that's really giving the mainstream steelmakers greater say in pricing their steel. And this is why we've been seeing margins for steel exceed, for certain types like even rebar, exceed $100, and that's I think pretty good for an industry that has been facing an overcapacity issue. Whether that will go on, actually, we are starting to see some signs of prices slowing down over the past couple of weeks, and hot rolled coil, if you look at flat steel prices, they've tumbled quite a bit, fair bit here. That's again as a result of slowing growth in Chinese automobile production. So we've seen that post a negative growth for the first time since the 1990s. Pretty chilling if you were to ask me. The white goods sector is also seeing slower growth than what we've been seeing previously.
Well, Keith, so is there any opportunity to buy into any metals right now? Are you picking up any favorites? Well,
I wouldn't make any recommendations for buying, but I would say metals related to the construction sector might, well, that would be for steel, for copper. We would need to watch out because we are approaching the winter. Actually, in fact, we've started the winter season in China, and that's where a lot of the production cuts will be enforced. So per our last count, various provinces have been asked to reduce production depending on the different companies' level of adherence or compliance to emission standards. So, it's not really been as sharp. We've not seen these, production figures take such a big hit, partly because a lot of the companies have taken the opportunity of the previous year to increasingly install facilities to deal with this emissions. So, in fact, I think some of the metals that you might want to take a closer look at might be those that are related to emissions management.
Also, Keith, the China slowdown has had its impact on the metals. Almost every economic data that has come in from China in the last couple of months or more has been on the negative side. What is your sense on a direct correlation of this on the metal prices?
I would say it's perhaps hard to tease apart what we are seeing by way of a seasonal effect, the winter effect. Demand for construction tends to ease during the winter, from one which is the impact of the trade wars. We will perhaps need to wait a couple more months to see, whether we can really for certain attribute the slowdown in growth to these respective two factors. For the other recipients of steel that we are seeing in the world, I would say, they perhaps are probably the main beneficiaries of what's going on, because for countries without their own domestic steel industry, they are relatively open, and with countries like China, with Japan, Korea trying to place their tonnages elsewhere, in fact, now's a good time for them to buy steel at a cheaper price. So it might not be great for countries that have their own domestic steel industry to protect, but if there are countries that do not need to do so because either they do not have their own steel industry, or if they still are a net buyer, I think they will be the main beneficiaries of this ongoing trade wars.
All right, Keith, we'll let you go on that. Well, that clearly is analysis coming on for the metal space. Continue to be soft for yet another quarter, at least, is a view coming in from S&P Global Platts. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.